Delta is one of the four major option Greeks, and it's by far the most important option Greek. You can darn near disregard every other option Greek, but you cannot disregard Delta. You have to know it, and you have to know it at a high enough level so you can be successful, because Delta measures two things. Delta measures the most important two things in trading. Number one, Delta measures your directional risk. Now ponder on that for a second. What can be more important than understanding your directional risk? Well, understanding your probability of success can be just as important, and Delta measures that as well. So if you understand Delta based on probabilities, you can set yourself up with an edge. That's what we believe here at the Dorian Trader. You can give yourself a probabilistic edge right from the start. Here at the Dorian Trader, we believe it's three pillars to understanding the basic options, and it's super important that you understand it, and that you understand it at a level that you can teach it. I've been saying that a while from now, because over the time of being able to teach people over the last several years, I hope that I'm getting better at articulating things to people and better at understanding what people actually need to be able to get over certain humps. But regardless of how I have articulated things over the years, the importance of understanding the basics of options have never changed. You have to understand the basics of options at a super high level, to the point that you can teach it. And you should be able to teach the basic options if you're going to become a really good options trader. You should know the basics in and out. So we believe it's three pillars here. The first pillar is understanding what is the call and the put, and what's happening when you sell the call and the put. And that's the image that you see. And that's what we talked about 2 weeks ago. Right? And you can see that video. I kind of broke it down a little bit. You can see the video on YouTube. The second pillar is what we're going to be talking about this morning, and that is the options chain. Some of the basics of the option chain. I'm not going to have the time to go over it in great detail, but I'm going to go over it as much as we can. But that's the second pillar. You have to understand what's going on with the option chain, because that's how you buy and sell calls and puts, and understand, probabilities and in the money, out of the money, things like that. And then the third pillar, which we're going to most likely talk about next week or as soon as we can, and that's the basic option strategies. Because understanding the basic option strategies is important, because everything that is any kind of strategy that's created with options is some type of deviation from the basic strategies, right? So if you understand the basic strategy, you'll be able to understand all the different exotic things people come up with, right? Even what we come up here at the Dorian Trader. So let's jump into the second pillar, and that's the options chain here. So I'm going to use this SPY as an example, this options chain on SPY with 32 days out, right? It all applies regardless if it's 0 days or 1,000 days from now. The option chain is still the same, but we're going to use this 32 days as an example. And I'm going to start by actually breaking it down in a really basic way. You can see that on an option chain, you have these dates, and this is the date of expiration, and then this you have this day here, like this is saying 0 DT, that means it's expiring today, right? And then you have down here, you have 122 days, and if we go even further down, you can see you have on the SPY, they give you up to 760 days here, right? So about 2 years there. And if you look at this W on here, that just means it's a weekly option. If you see a Q, that means it's a quarterly option. If you don't see a W or a Q, it's most likely a monthly option that expires on the third Friday of the month, right? So the third Friday of December is most likely December the 20th, and that is the case. So that's 4 days from now. The third Friday in January is the 17th, and that's 32 days from now, as you can see here. Okay. So that's how you kind of differentiate or understand the option chain just from this viewpoint at this point. And then you get to decide which expiration you want to click on. So we're clicking on the January 17th, which is the third Friday of January, which is 32 days from now. It's going to expire in 32 days. So if I click on that, you can see that it's saying January 17th here, and it's saying 32 days. Okay? And it's all associated with the SPY. This is the ETF, the S&P 500 ETF. An ETF is it's like a mutual fund that trades like a stock. Okay. And so the SPY was the first one ever created, and it's still the most popular one, and for a number of reasons. So when you're looking at an option chain, when you open it up, it looks like this. Right? And then you're going to have two sides. You're going to have the call side, which is the left-hand side. All of these are calls on an option chain. And then on the right-hand side are puts. All of these are puts. Okay? So you got left-hand side and right-hand side. They kind of mirror each other. The only difference is one side is calls and the other side is puts. Then you have down the middle, you have these are the strikes. These are what are called standardized strikes. And they're standardized because the exchanges set these strikes, and you can see these strikes wherever you're at in the world, and you'll see these same strikes if you're trading the SPY with a January 17, 2025 expiration with 32 days to go. These strikes will only be added to within the next 32 days. They will not change, meaning, excuse me, go away. These strikes here, they can only be added to, right? So if you had a 59, a 550, a 597, and a 598, that's all 1 point wide differences. Well, the exchange could do a half point, right? They could do a half a point, and sometimes you'll see that, or some weird type of breakdown. They can do that if they wanted to, okay? But it'll still be standardized, meaning everyone can see it and everyone can trade it if they desire to do that. Okay? So when you're looking at an option chain, going up on your screen is actually going down. So you have the 606, the 605, the 604, and so forth. This is actually going down. So going up on your screen is going down on an option chain. And going down on your screen is going up, right? So you got the 607, 608, 609, 610. That is going up. So it's kind of confusing initially to beginners, but as you trade these, you trade options and use the option chain more, it's gonna become a lot more understandable. And to me, it's the right way they have this set up. Okay. If you're on TastyTrade, and I don't know why they have this, they didn't have it originally, but they do have this little button here that you can switch it, and it can the going up could be the option chain, and going down can be the option chain, right? So it's more counterintuitive to what we normally look at, but it's going to be crazy confusing if you set it up like this. I don't know why they gave this option, but they have. But sometime you're going to hit this on TastyTrade and it's going to confuse you. Just look at that and make sure this arrow is pointing up, and it's going to give you it's going to set you up the way you need to be set up. Okay. All right. So once again, calls it to the left and puts it to the right. This orange horizontal line that's going across the TastyTrade platform, you might say it's brown. I'm saying it's orange, but maybe I'm colorblind. So this is what is called the at the money line, the ATM. And that's where the stock is just currently trading at. So if the stock is trading at 606.75, that's the at the money area, right? So basically in this area is the at the money line. At the Dorian Trader, we consider the at the money line the equilibrium, the baseline. This is where everything starts at, right? And this is what you're going to be trying to go towards and go away from. This is the the baseline. This is the equilibrium, as we call it here at the Dorian Trader. You need to know where you're at on an option chain at all times, and it starts with the at the money line, and that's always where the stock is currently trading. And so if you didn't have this line here, the at the money is still exactly where the stock is currently trading. Okay. Now on the call side, the left-hand side, above the at the money line is what is considered the in the money area, the ITM. And below the at the money line is on the call side is considered the out of the money area, the OTM. And then it's the opposite on the put side. This is the OTM, or the out of the money area. And then this is the in the money area on the put side, the ITM. So it is super important that you understand the dynamics of the option chain, and that includes understanding, are you at the money, in the money, or out of the money? You need to know this at all times, because you have what is called rights and obligations when you're dealing with options that we talked about in the first pillar. Okay. You If you are the option buyer, you have a right to buy. If you're on the call side, you have the right to sell if you're on the put side, and you most likely will exercise those rights if you're in the money. Doesn't mean you will, but the higher probability is that you're going to be in the money when you exercise your right. So in return, that means that the higher probability for being assigned the obligation, right? If you're the option seller, is when it's in the money. So if you're the seller of the put, you have an obligation to buy that. The higher probability of that happening is when it's in the money. Doesn't mean it will happen, but that's the higher probability. If you're the seller of the call, you have the obligation to sell shares. And so that obligation is higher if it's in the money. So you need to know what's happening at all times. Are you at the money, in the money, or out of the money? And by understanding that, you'll also understand your probabilities better. So if you are the option seller, you're going to have a higher probability if you're selling something out of the money. And if you are the option buyer, you're going to have a lower probability if you're buying out of the money. You want to know these things. It's important to understand where you're at on an option chain. So also on an option chain, you have what is called the ask, excuse me, you have the ask and you have the bid, and it's mirrored on both sides. Okay. The ask is where you buy at. You buy at on the ask. If I was going to buy this 600 strike, it's going to be green on the platforms we recommend most of the time. Green means buying. It doesn't necessarily have to mean that, but most of the time it does. If you're buying, that's clicking on the ask. If you're selling, that's clicking on the bid. Okay. And most of the time it's red if you're selling on the platforms we recommend. That is the same thing if you were going to be buying the shares or selling the shares. If you buy the shares up here, you're clicking on the ask. If you're going to sell the shares, you click up here on the bid. The bid is always sell. That's why TastyTrade has tried to highlight sell and they tried to highlight buy. The bid is always selling. The ask is always buying. What you're trying to do is buy and sell at the mid price, right? So in between the bid and the ask is what it's called the mid price. You have to worry about that if you're doing a single option. If you're doing a spread, the platforms are going to give you the mid price automatically, at least the platforms we recommend. But if you're doing a single option, buying or selling it, you're going to have to make sure you put it at the mid price. Or you're going to be buying on the ask or selling on the bid, and that's what you do not want to do that most of the time. Okay? So that's what the mid price means. It means the price between the bid and the ask. Okay. So also on an option chain, you have what is called delta. Okay. You have delta. And you can have some other stuff, but the most important things of what I'm talking about right now, right? Is the most important things I'm mentioning at this time. And delta is one of those important things that we all have to have on our options chain. And if someone tells you you do not, run from that person or those people because they're charlatans giving you or pointing you in the wrong direction. Okay. Delta is one of the four major option Greeks, and it's by far the most important option Greek. You can darn near disregard every other option Greek, but you cannot disregard Delta. You have to know it, and you have to know it at a high enough level so you can be successful because Delta measures two things. Delta measures the most important two things in trading. Number one, Delta measures your directional risk. Now ponder on that for a second. What can be more important than understanding your directional risk? Well, understanding your probability of success can be just as important, and Delta measures that as well. It measures your directional risk and your probability of success. The two most important things in trading, in my opinion, period. As for directional risk, Delta measures how much you will make or lose based on a 1 point move. So to simplify this, think about shares. If you own one share or 100 shares, each share you own equals one delta. So if you had 100 shares in SPY and it went up 1 point, that means you would make $100. Right? You got 100 shares, that equals 100 deltas. It goes up 1 point, you're going to make $100. If it went down 1 point, you would lose $100. Delta measures how much you will make or lose based on a 1 point move, a $1 move. As for the options, it measures how much that option is going to move based on a 1 point move. So if you had a 34 delta, it means it's going to move 34 cents for every $1 move, at least initially. It's not static. Static means it stays the same. Delta is dynamic. It's constantly changing. So you can start off with a 34 delta, and then it can go higher, as high as a 1, or it can go lower, as low as a 0. Delta is dynamic. It changes. So if you bought an option that started with a 50 delta, that means it's going to move 50 cents for every $1. If you bought it with an 80 delta, it means it's going to move 80 cents for every $1 and so forth. Okay. If you have on a bunch of different things, let's just say you had on, let's just say 5 different stocks. You can have on 100 different stocks, 1,000 different names. You can have on as many stocks that are publicly traded, and you can beta weight it to a certain delta. It's not going to be perfect, but it's going to be as close as perfect as you can get it to be if you beta weight something based on the market. So here at the Dorian Trader, we normally beta weight to the SPX, the S&P 500. So it'd take all your shares and make it equivalent to only having on the SPX. So that means if this said plus 20, that means all your different companies you have shares in, it's equal to being positive 20 SPX deltas. So that means if the SPX goes up +1, you're going to make $20 overall. If it goes down -1, you're going to lose $20 overall. It's not exact, but it's exact enough for us to count on this, for this to be an amazing gauge for us to manage our overall risk on portfolio wise and on individual trade wise. So it's important to understand delta on a high level regarding risk here, okay? Because it measures how much you make or lose based on a 1-point move, how much that option is going to make or lose based on a 1-point move. So I also mentioned that delta measures your probability of success. And so we're going to talk about that, and then I'm going to have to call it quits on this for today. But if we go back to this at the money line, going across the TastyTrade platform here, the ATM, this is important to understand your probabilities. You want to go back to that equilibrium that we call, once again, at the Dorian Trader, that baseline. If you're at the money and you're going to buy some shares, right? It's trading literally right now. If you're going to buy the shares, well, right when you buy it, it's a 50-50 shot that it can go up or it can go down. Those are the probabilities at that time. A coin flipping odds, which is not bad, right? Which is not bad at all. I always tell people, man, I'd rather have a 50-50 shot than something less than that when it comes to trading. Rather have a 50-50 shot. So if you're buying or selling something at the money, you basically have a coin flipping probability of winning, a 50-50 shot of winning. Technically, it's worse for the buyer and greater than that most of the time for the seller. But for simplicity purposes, just think of at the money as a coin flip. And then what you want to do is say, okay, how can I have better than a coin flip? It's pretty much nothing you can do buying wise besides buying something in the money, options wise, that you can have better than a 50-50 shot. But it's almost everything you can do selling wise and have a greater than 50-50 shot of winning. So that's why here at the Dorian Trader, we are primary option sellers, because we can determine our probability when we initiate in a trade. And as I said, it's nothing more important in trading than understanding your probability of success. It's just as important understanding your direction of risk. So if I initiate a trade and I know at that time I have an 85% chance of winning, and then as the trade progresses, and if I can know my probability at every stage of the trade, that's empowering. That's data that can make a huge difference in my win and loss ratio. And options do that. Options do that. So when you're thinking about probabilities, I want you to think about expiration, the time of expiration, because options can predict the future with the win rate of 68%, or one standard deviation of the time. Options can predict what's going to happen in the future based on a range, not an exact price, but a range that is super important. It's super important. From all the buying and selling of all the calls and puts from a expiration period, and using a formula that's called the Black-Scholes formula or model, an implied volatility is formed, and from that implied volatility, which is this here, an expected move is created, and that expected move is telling you where the market is predicting it's going to expire at expiration. Not a second before or not a second after, but literally at the time of expiration. Right now, let's just say plus or minus 15. The SPY is going to expire within plus or minus 15 in the next 32 days, and it's got a 68% chance that's going to happen. These numbers have been scrutinized for years, and they pan out all the time. So if you understand delta based on probabilities, you can set yourself up with an edge. That's what we believe here at the Dorian Trader. You can give yourself a probabilistic edge right from the start of your trade. And you can continue to perfect that edge by understanding how to adjust and understand your probabilities throughout the trade. 68% of the time, it's going to stay within a 1 standard deviation move. At the Dorian Trader, we try to set up most of our trades at 1.5 and a lot at 2 times the expected move. So we usually sell something no higher than a 15 delta, which the inverse means we have an 85% chance of winning something, at least 1 cent at expiration. That's what probabilities are mostly about, winning something, not losing. So if we collected $215 here, it doesn't mean that we're going to win $215. It means we're going to win something and not lose. Okay? Most of the time, we're selling stuff really far away, like at a 5 delta. So if we sell something at a 5 delta, that's going to give us a 95% chance of making at least something at expiration. Significant odds, that's our edge. That's part of our edge. That's not the only part of our edge, but that's a significant part of the edge we have as Dorian traders. It's understanding probabilities at a high level. So you have to understand the options chain. You have to understand what's going on. All the different points we just pointed out. You have to understand it. You have a lot of resources that you can go over to get to understand that. Course 1 that we have. Talk about the basic options in lesson 2 of course 1. Super important. Bunch of YouTube videos that you can check out. You can always come and present your questions on the live calls, because we encourage members to unmute your mic and present your questions. You have to understand this pillar. This is an important pillar of the 3. It's understanding this option chain.